So we are seeing that now silver and mining stocks are now finally breaking out. And in the second half of every big gold bull market, it's really the time for performance gold to outperform. Yeah? So gold always goes first. And then with the time lag, it's silver, the mining stocks, and then commodities following. And this is what we're seeing now. At the peak of a big gold bull market, the gold-silver ratio tends to go to 15 to 20. If my ambitious gold targets are accurate, then silver is probably the buy of the century now. If gold goes to, let's say, 6,000, and we go to a gold-silver ratio of 20, I mean, the math is pretty easy. Yeah? That's a $300 silver price.
Welcome to the Microscopic Podcast presented by GoldRepublic. My name is Alexei Joranov, and in this format I invite you to look at the world through different lenses to see what's hidden in plain sight. I hope you will get fresh insight and enjoy this conversation. If you do, as always, please give it a like and subscribe, but also leave your actions down below in the comment section and share it to those who need to hear this. But before I start, I'd like you to know that if you open an account at GoldRepublic, you will receive 1 free gram of gold. Just click on the link in the description. Today I have the honor finally to meet you in person, that's number one, and to have this interview that I was really looking forward to because of, you're one of the author, or you started the report in Gold We Trust more than 20 years ago. You're the managing partner of Incrementum AG. And today we're sitting here, we are at, not right now, but there was the Precious Metal Summit happening. And it's I think the report that you publish every year with also obviously your whole team that puts a lot of sweat and effort into making it is to me a standard. I love always looking forward to read it when it's published. So welcome to the Microscopic Podcast, and also the documentary that we are producing at the moment with Jan Viv, Gold in the New World Disorder, from which we will take segments from. Welcome.
Thank you very much. Thanks for having me. It's a pleasure.
My first question would be more about where we are in the cycle now. We've seen an incredible growth of the price of gold in the last few years. And a lot of people are asking themselves, are we peaking? Is this the top? Or are we still in for a longer ride, a huge upward move?
Let's be honest, gold is not a contrarian asset anymore. We had that previously when people couldn't care less about gold. Nowadays, there's journalists calling me up. There's like national TV wants to have my opinion on gold. This is normally not what's happening when something is really in a bear market. So I always think that, the so-called Dow theory, based on Charles Dow, the founder of the Wall Street Journal, and he calculated the first Dow Jones index. He said in every bull market, there's 3 different stages. There's the accumulation phase, where it's only like die-hard contrarians buying. This is like when you go to a cocktail party and say, I'm buying gold. People say, you're crazy. Yeah, gold will continue falling. I mean, it's like it's a barbarous relic. Yeah, it's a pet rock. Don't buy it. Yeah. But then the second stage is the so-called public participation phase, which is by far the longest phase. And this is the stage where, price starts rising, where we see that the media picks up on the topic, where analysts are getting a little bit more positive, when there are like new products being launched and everybody's getting more excited. So if you go to the cocktail party again, you will say like, okay, I'm buying gold. People say, oh, that's interesting. I also have like a 2% allocation to gold. I think gold is a good investment. And then the third stage is like the mania phase, the distribution phase. And this is exactly the phase when those contrarians that bought low, they're selling to the Johnny-come-latelys. And this is the phase where everything gets crazy and people are looking for more and more leverage if you go to the cocktail party again and say, I like gold, I'm buying gold, people say, no, you have to buy silver mining equities. Yeah, you have to buy them with an enormous amount of leverage. Yeah, you have to buy like the riskiest stuff. And I think we're not there yet. I would say we're like somewhere like in the second half of this public participation phase. So I would say in football terms, like, somewhere in the middle of the second half, from my point of view. We're not, at the end of the game. Perhaps there might be overtime, yeah. Perhaps there might be a penalty shooting, yeah. So it's going to be a really long game. But we have seen over the last couple of weeks, just the month of October, gold was up $400. I woke up in the morning, looked at the screens, and I saw gold up 2-3%, new all-time highs. I got used to that, but I also kind of knew that, okay, this won't last forever. Now we're seeing some sort of consolidation, which is healthy. But my take, long story short, is we're still in a bull market. We haven't seen that mania stage yet. So I think the next couple of years will be good for us. But don't be greedy. This won't go on forever. But I think as I've said, the next couple of years should be pretty positive for us.
So now if we look more about in historic terms, about the cycle of gold, but especially about the last maybe 200, 300 years, how would you say that gold evolved throughout those phases?
Well, we've had, the classical gold standard was actually pretty short time, yeah, from the late 1900s until the first World War. And before that, money had always some sort of backing by gold and or silver. So for a pretty long time, we had a bimetallic standard. But then I think the market basically decided that he prefers gold over silver. So then, of course, we had the First World War. We had obviously 1913, the Federal Reserve being launched. And then after the Second World War, we went into the Bretton Woods Agreement, yeah, and we had a couple of decades where actually the British pound, but also the US dollar were like the world's reserve currencies, like basically at the same time. But after Bretton Woods, the US dollar basically came out as the sole, world reserve currency. I think one of the reasons for that is actually that the US owned by far the most gold. They had 29,000 tons of gold at the highest point. So I think that was the main reason why the world decided back then at the Bretton Woods conference, okay, let's have the US dollar as the world reserve currency, because they've got the highest gold backing actually. Yeah. And of course we all know what they did with that trust, which ended then in 1971. So I think if we talk in cycles, the current full fiat era is like totally the exception to the rule. And of course that's a pretty long exception, but in historic terms, yeah, that's just basically just a blink of an eye if you compare it to the 5,000-year track record of gold. So I know that, talking to bankers, to people in the financial markets industry, talking about those long cycles, yeah, they couldn't care less. But for example, yesterday at my keynote, I showed a chart of the so-called shadow gold price. Because it's hard to value gold, yeah, and you can value it to gold, to oil, to commodities, to various products, and then gold is actually already pretty expensive. But I wouldn't compare it to things that we consume, but rather to things that we print. So I'm regarding gold as a monetary asset. So I'm always comparing, gold compared to monetary aggregates, yeah, like the monetary base and 2 and 3 and so on. But to come back to that shadow gold price, this is basically the backing of the monetary base with gold reserves at market prices. Now, currently we're obviously far below that. We are roughly at, I think, 20% backing of the monetary base. However, we saw in the late 1930s and until the mid 1940s, and then also at the beginning of 1980 up until I think 1982, that the monetary base was actually covered with more than 100% gold. So there's some sort of rhythm. And I think like 40 years is kind of this natural pattern that we're seeing. So, from 1980 to 2025, I would say we're kind of overdue already. And if we would go back to 100% gold backing, that would be $21,000 gold price now. So I think what's really important going forward is like, thinking long-term cycles. And as the famous blogger, friend of another once said, you only need one gold revaluation in your life. And I think it's going to happen at some point, because if you study monetary history, if you go from one currency or from one monetary system to another, especially the time in between is the time when you actually need gold. This is the time, for example, when they introduced the euro. I think 1998 or 99, they had like campaigns where they said, we've got, I don't know, what was it back then, 11,000 tons of gold in the Eurozone. So actually, implicitly, they said like, okay, we have some sort of gold backing for our new currency that is being launched. So I think in those phases in between, this is really where gold plays its major role, and therefore it's no coincidence that the most important geopolitical players, they already own quite a lot of gold, or they're still buying enormous amounts of gold. Yeah. So I think that's kind of the long game that we're in, and we're coming closer to this point every day. Yeah. And stuff like de-dollarization, we are writing about that for 10 years. Then you've got the debasement trade is now that's like a big thing on Wall Street, and it's interesting because we've got the debasement trade since 1971. But those things, and sound money, and there was like Morgan Stanley coming out with the 60-20-20 portfolio with 20% gold. I mean, that's Morgan Stanley. It's not tiny incrementum. Yeah, it's like a big Wall Street firm. So I think we're now getting there, and the things that we're covering for 2 decades almost, they're now really happening. Yeah, and that's pretty exciting.
It is. So would you say that this move is somewhat different than previous appreciations? When we look at the velocity, the speed at which every next $1,000 or even 500, and the speed to which it achieved that level, is it comparable to anything you've seen and your big long charts and cycles in history before? And what happened then?
I think I wasn't alive in the 1970s, yeah, and I think the time 1979 was really like a strong bull market. But what we're seeing now is like every minor correction is being bought, and there's so much capital waiting on the sidelines. I think it's like, so last year we said this bull market is primarily being driven by emerging markets. So we're very much focused on what's going on in the US and in Europe, but actually the center of the gold world isn't in Europe anymore. That's in Asia. And I'm traveling quite a lot, and if you go to India, if you go to Dubai, if you go to Saudi Arabia, I was there in January, for example. If you go to China, obviously, gold plays a much more important role. So I think this is kind of the positive case for gold that many people tend to forget in the Western world, because for most people here, it's like this doomsday scenario, everything will go to hell, Mad Max scenario, hyperinflation, currency reform, buy gold. But if you go to emerging markets, that's a different case for gold there. And I think, there's a very strong gold culture there. And with, rising GDP and prosperity in those regions and people can consume more and they become more wealthy, they tend to buy more gold. Yeah, that's just a very, very high correlation. So I think the foundation of this bull market is really the physical demand coming from emerging markets. Now on top, you've got the Western world that basically was asleep and didn't really recognize this bull market that was already happening. And now they're like the Johnny-come-latelys. They're kind of considering, there's a big party and I'm kind of standing outside. Should I still go to the party? Is it already too late? Perhaps the admission is still too expensive. So this is going on, and I just see, to answer your question, is really an enormous amount of strength in this bull market.
So you've already mentioned a few of those drivers, but for the sake of the conversation, I'll ask you in a different way. Why do you think central banks have turned from net sellers to net buyers after the great financial crisis?
Well, I think, we had the central bank gold agreements where, based on them, Western central banks said, okay, we'll limit our gold sales, and it was basically exhausted, and they were like, coming to the levels where they felt comfortable, and let's it's easy to ridicule those decisions and the brown bottom when Gordon Brown sold English gold like at the worst prices. But you also have to understand that it was like a 20-year bear market in gold. Yeah, we're going down from 850 to 220, 230. Yeah, so there was also an enormous amount of pressure for quite a long time on those central banks. Why are you still holding this stupid metal that keeps falling for 20 years? So I think we also have to understand that component. But then obviously with the great financial crisis, first of all, obviously there were like things like zero or even negative interest rates being implemented, something that didn't exist before. Then very sophisticated things like quantitative easing, and all those, all those acronyms that we learned about over the last couple of years, that are mainly inflationary, from a monetary point of view, obviously. So this was basically the kickstart for many central bankers kind of overthinking their position on gold. And then obviously 2022, this was the year when it really got through the roof. Yeah, so we got 3 years in a row now with central banks buying more than 1,000 tons of gold. That's like roughly a third of annual gold production. So this is significant. And now we are on track probably for 2025, 1,000 tons, perhaps slightly below. So this is like a big move. And 43% based on the central bank gold survey, 43% of the central banks say they will continue to buy gold, which is a record amount. So I think that central banks will continue to be a major player in the gold market and also part of this, foundation of this strength of the bull market.
So most notably in Europe, if we just focus on the European image or a snapshot here, most notably, the Polish central bank started accumulating aggressively, Hungarian as well, Czech Republic. Do you think that other European countries will follow?
I was really stunned when the governor of the Polish central bank said they want to go up to 30%. It's quite aggressive. And I think that Poland, but also Hungary and Czech Republic, they're kind of the bad guys within the European Union. They've got their somewhat separate, strong opinions, and they're perhaps not that leftist to some degree. And I think I just did a big presentation in Prague, and I thought it was staggering because they lived through socialism, yeah, and they know what it does to society and to your economy, and they're really, really against it. And I think that's their opposition is also, rooted in their history, which is not so far away. And I remember the year '89 very well. So I think that's one of the reasons. But if we'll see like Germany or Austria, whatever, the central banks buying gold, I just don't see that coming in, at least in the next couple of years, because there's so much pressure from a budget point of view, and the media will say, we should distribute the money for more important things and not buy this stupid yellow metal for the central bank. Yeah, so I don't see that coming.
Mm. Indeed, actually, I talked to an advisor of the Central Bank of Poland who told me that even in Poland, it was very controversial, actually, the way they purchase gold to this rate.
And I think that if you're within the euro, you're not really allowed. I think there's like a process if you want to buy physical gold for approval. So I think it's, but I'm not 100% sure about that. I have to read that up. But it's not that easy. You cannot say, okay, I'm buying gold now if you're within the euro system.
I would just speculate here, but I would guess that it has to do, obviously, if you buy gold, you're not buying, it kind of underlines the role of the euro, especially in a scenario where, let's say, a country just wants to decouple from the euro, which could be the case, even like maybe anytime soon. It's a probability, and that buying gold would signal a way of backing then their own currency if they want to exit the euro.
Absolutely.
That is actually one maybe scenario that we can interpret also those purchases. But now if we look more, let's say globally, who are the biggest purchases in the last years?
So the largest central bank buyers over the last couple of years were obviously mainly coming from emerging markets. Yeah. So we had China, India, Russia also. Big purchaser, and I think for China it's pretty obvious. It's like an open secret that they buy significantly more than they openly announce. Then we've got in Europe, we've got Poland, Czech Republic, we've got Hungary, we've got Turkey buying significant amounts of gold. But then we've got also Singapore, for example. Yeah, so it was a pretty. I think that the number of central banks purchasing gold reached a new all-time high. So it's a really broad trend, yeah, and it's primarily also countries that kind of want to diversify out of the US dollar, out of US treasuries. So that's no coincidence. But then on the other hand, I always said that before the de-dollarization comes the de-euroization, and we're seeing that gold is now, but also due to the price appreciation, obviously, is now the second most important reserve currency. So it overtook the euro as the second largest. And it's probably no coincidence that a couple of days after the ECB came out with a report bashing gold, saying, it's so it's so speculative and it's so dangerous for the financial system. So it's a very broad trend, yeah. And I think that, if you compare the percentage of gold ownership in the Western world compared to emerging markets, yeah, there's still lots of room for emerging markets to basically get to the same levels like the Western world. And I think that gold plays a very, very important role for that countries. Yeah, and we've seen, the meeting of the Shanghai Cooperation Organization where Vladimir Putin, Xi Jinping, but also Modi from India, they seemed very, very close. And I think, one day after this big meeting, there was this huge energy deal being announced. And one day after, there was like this big military parade. So I think that, I don't think that there will be a gold-backed BRICS currency, but I think that those countries, they fully understand the importance of gold, because you want to have a neutral, non-inflatable, reserve asset without any counterparty risk. Yeah, that's what it's all about.
So if we now dig a bit more into the topic of this new formation of, let's say, the monetary system as a whole. We see gold rising, resurging from its past function, actually, and recentering in this monetary system. There's a lot of chatter and talk about BRICS currency, gold-backed BRICS currency, re-anchoring of gold in international trade settlements, and these kind of things. How do you see the future role of gold in the monetary system under this lens?
Well, I think if you read the statements after the BRIC meetings, it's always very kind of vague. So there's, we were discussing this and that, and this is important, but it's, setting up a new system with, just the settlement infrastructure. That's a really complex thing, really complex. And, BRICS countries are now like with the addition of the new members, there's like, I think 3 billion people. And it's not like a homogeneous group of countries. Yeah. China and India, until recently, there weren't any direct flights between China and India. Yeah. They're definitely not best friends. I think they're playing it in a very pragmatic way nowadays, especially India is very pragmatic. They say, cheap oil from Russia, we'll take it, yeah. But then on the other hand, we want to be friends with everybody. So I actually don't think that there's this BRICS pay and so on, but it's not really picking up momentum. I think that China is really, really serious about those developments. And I think that their plans are much more concrete than the plans that the BRICS actually have. And it's obvious, yeah, in bilateral trade, there's like the renminbi has become an important currency, yeah. So there's so many bilateral deals now being made where they don't settle in US dollars anymore, they settle in renminbi. So from my point of view, it's definitely going into that direction, that there's like a parallel new monetary system being developed. But this is a long process. This is a really long process. And as I've said before, we had the British pound and the US dollar basically being world reserve currencies and the leading currencies for almost 2 decades, yeah, in parallel. And I think that Donald Trump and his administration, they totally get it. They totally get it. And if you listen to Scott Bessent, he said, I want to be a part of this Bretton Woods realignment or a Mar-a-Lago Accord. Yeah. If you listen to Stephen Mirren, who's really, he wrote the playbook basically, for the way forward. And I made like 2 big threads on Twitter analyzing it. Yeah, I think they're fully aware of the fact, the Triffin dilemma, and they're aware of the fact that they on the one hand they want and need a very weak US dollar for the renaissance of US manufacturing, but then on the other hand they have to defend this exorbitant privilege of issuing the world reserve currency. Yeah. So they want to have both things, which, is squaring the circle. And this is really the fascinating thing that they're now openly talking about the big monetary game that we're in. We haven't seen it from the Biden administration. Yeah, nobody in Europe is talking about that. But the Trump administration is really talking about that. And, all those things like stable coins or discussions about revaluing gold or a strategic Bitcoin reserve, yeah, or gold-backed bonds, Judy Shelton, for example, yeah. I mean, that's, we in the gold world, we're now like, this is like center stage, yeah. We were playing, if you're like at a music festival, gold was always like this, where only like the super drunk people hang out, and there's like 20 people watching this artist, and now this is like the center stage, and I think this is really fascinating. So let's not underestimate the Americans when it comes to that. But then on the other hand, we also know that China is always playing the long game. They've got their strategy and they're focusing it. They don't have midterm elections coming up. Yeah. So I think that gold plays an important role to that. And as my friend Jim Rickard said, if you want to play poker with the big guys, you'll have to bring the chips, and those chips are golden. Yeah. And I think, as I've said, the most important countries and institutions, they own lots of gold. Yeah. So therefore, if there would be a revaluation of gold, or let's say a devaluation of fiat measured in gold, like we've seen it previously a couple of times in history, I think actually quite a lot of countries would actually profit from that.
Now, I'm also interested about then more in detail about what you just described with the plan for like the U.S. administration to actually rewire this trade structure, like global trade. How exactly will they go about it, and how far are they actually really in the plan, and can they even succeed?
I don't know how far they are, but I think that it's what Stephen Mirren described. That's basically, and it's a very complex paper, and he's also writing about this. It's basically sticks and carrots, yeah, and how to attract people coming into your team, yeah, and if they not wanna join your team, what to do, to really hurt them, yeah. And tariffs are a very, very important tool for that, obviously, and we've seen that. But then also access to like the military shield or umbrella or whatever. Then, of course, always direct investments into the United States. So that's like the deals that they did with Japan, for example. Yeah, it's really interesting how much capital is now being invested by the Japanese in the US. So I think what Stephen Mirren described. You've basically got green countries, yeah, friends of the United States. Then yellow or orange countries, yeah, don't know, could go like either direction. Then you've got red countries, yeah, they're the enemies, yeah. I think this is playing out now, yeah. And for example, Argentina, they wanted to join the BRICS, but then they made a U-turn and said, no, we are getting closer to the United States. And now, interestingly, the United States, they bought Argentinian pesos, yeah. They kind of provided liquidity to them, yeah, and they were really, really supportive, yeah, buying their currency. So they're obviously in the green camp, yeah. And so I think what Stephen Mirren also describes is those basically setting up a big fund, a big investment fund, and there talks about revaluing the U.S. gold reserves, which are still valued at $42. So just from an accounting point of view, you could have like a windfall profit of more than a trillion now. Now, a trillion doesn't really move the needle, with U.S. debt at levels that they are currently, and that's less than the interest that they're paying on that debt in 1 year. So a trillion sounds like a lot, but it doesn't really make a big difference. But then if gold goes to, I don't know, 8,000, 10,000, 15,000, okay, it's different. And then Mirren writes about how you actually could take leverage on that money and buy various things like commodities like Bitcoin, for example, like real assets, how to support the economy and start like a kind of a sovereign wealth fund. I thought it was a really interesting topic, and I think that perhaps it's now really playing out. What hasn't really materialized yet is like really a big bear market in the US dollar. We've seen some signs for that, but if you compare it to previous bear markets, since 1980, they were between 35% and 50%. So I think we would still have to see it. But then the question is, devaluing against what? Against the euro? I mean, the euro to the US dollar was like 160 previously. Now we're like 115, and everybody in the Eurozone is complaining that the euro is so strong. Devalue versus the Japanese yen. I think the US dollar has to devalue versus the Chinese renminbi. That's like the big story out there. The Chinese renminbi is way too cheap at the moment. I think also the Japanese yen is way too cheap. But then if you really aggressively devalue the US dollar, what's going to happen to inflation? So this is like the very, interesting game that we're in, really like squaring the circle and reaching all those targets, like a renaissance of manufacturing, then protecting the US dollar as the world reserve currency, then not making China too big and playing them with their initiatives, and then not causing the next leg up in inflation. That's it's not going to be easy, and something's got to give.
Sorry to interrupt this episode, but I'd like to tell you more about what we do at GoldRepublic. At GoldRepublic, we provide physical gold, silver, and platinum, fully insured, fully in your name, fully allocated, in top-tier vaults, securely saved in Amsterdam, Zurich, and Frankfurt. No paper promises, just real ownership, full transparency on your name. We are fully regulated and conduct regular independent audits of our vaults with more than 700 million euros of precious metals under custody and 70,000 investors that trust us in the last 15 years. Our top-rated app gives you full control. Track live prices, explore detailed charts, and buy or sell in just a few taps. Whether you're hedging against inflation, currency risks, or financial stability, at GoldRepublic, we offer real assets to safeguard your generational wealth. It's a lot of juggling.
Yes,
it's exactly. A lot of juggling, yeah. And we might see more balls fall once the first starts to drop. But indeed, it seems like it's a plan, and if it works out, only time will tell. But overall, if I'm resuming it, it's really about the battle of collateral. It's a battle of the next reserve asset, which would rival the US dollar. And there's also something that you've mentioned in your presentation yesterday morning, was the fact that in the last couple of years, there was a lot of chatter about de-dollarization and about the fact that people or central banks, countries are dumping treasuries. Mm-hmm. But if we look at the appreciation of gold and the correlation with US treasuries, usually it's inverted. Mm-hmm. But now we've seen something very atypical, which was that they both moved in tandem for the last couple of years. Why is that?
Well, I think that I think the more important correlation is obviously the correlation between bonds and equities. Yeah, and this correlation was positive over the last couple of years. It used to be negative for roughly 2 decades, a little bit more. So basically that means, if equities lose, then bonds will be kind of an insurance for your portfolio. And this is the reason why this 60-40 portfolio came up. So bonds kind of stabilize your portfolio. But this changed in 2020 and then especially in 2022. And the main reason was inflation, obviously. Yeah. People always say that inflation is great for equities. It depends. Yeah, it depends on your business model. It depends on your pricing power. It depends on the sector that you're in. But obviously, when you've got a sudden surprise of inflation, then bonds are like the worst asset class to be in. Yeah. So basically, if you remember the Bud Spencer movies, I loved to watch them when I was a kid. Bud Spencer and Terence Hill. Bud Spencer always make this move, in Viennese it's called the Stereowatschen. So, this did hurt like institutional portfolios, over the last couple of years, especially 2022, losing it on the equity side, but then bonds actually not being an insurance policy, but actually adding to those losses. So I think that was the point in time when many people started realizing, well, perhaps gold worked pretty well as a portfolio stabilizer. And I think that this is really where the future demand for gold will be coming from. People always say that equities are the enemy of gold, and I think we're kind of an real asset house, yeah. So we've got high equity allocations, and I think that's there will always be need for like entrepreneurial energy and companies finding solutions for all the problems that we have, yeah. So I think there will always be a case for equities. Then you can of course discuss the jurisdiction, the sector, the valuations, and the weighting of equities in your portfolio, definitely. But I think that the real enemy of gold is actually fixed income, and fixed income is like 160 trillion market. And now, I think like if this is like a big cake, yeah, the 160 trillion fixed income cake, I think there's more and more little breadcrumbs coming and moving to the gold space, because people realize, well, actually, inflation isn't dead. We're now, above the 2% level, which is ridiculous anyways, yeah, for a couple of years, and central banks are still lowering interest rates, yeah, which is not their mandate actually. And people realize that, or let's say some people realize, yeah, you've got some closet gold bugs sitting in some big institutions, yeah, they're managing like huge amounts of money, and then if you talk to them privately after 2 or 3 glasses of wine, they say, yeah, my portfolio is full with gold. So I think that more and more people realize that gold is a really good diversifier. Gold works as a bond hedge, as a inflation hedge, as a recession hedge, as a dollar hedge, yeah. And I think this is really just starting. And Morgan Stanley 60-20-20 portfolio, Jeff Gundlach, the new king of bonds, he said you should have like a 25% allocation to gold. And I remember my colleague Mark said that in the 1970s there were actually bond funds in the US that had a physical gold allocation of 20-30%. So I think this is the real story behind more and more people in the fixed income space realizing, well, perhaps we should own at least some gold.
And that's a great transition towards the next question, because you also split gold into the safe haven sleeve and the performance sleeve. So can you maybe define each and the role they play in a portfolio?
Yeah. So people ask me, should I buy gold or should I buy mining stocks? And I say, that's completely different. Yeah. And I always ask, what's your motivation? Yeah. What's your scenario? If you expect like the end of the world, if you expect like higher inflation, negative real interest rates, a devaluation of fiat versus gold, then perhaps also like real troubles in our monetary or like the financial system, a little bit like 2008, 2009, or even worse, then I think it's a different scenario than if you say, well, I think gold is in a bull market and I want to have the most leverage on it. So from my point of view, you should have like 15% of what we call safe haven gold. So this is physical gold stored in a safe jurisdiction. Don't care about the price too much. Yeah, really, this is just a strategic monetary reserve. Best thing that can happen, I'll inherit it to my kids, to my grandchildren. Make sure to get the storage right. Not everything in one place, perhaps outside of the banking industry, in a safe jurisdiction. There's many, many people that I'm talking to, really ultra high net worth and big institutions. They are now really considering diversifying the gold allocations where they're storing their gold. It's a really big thing. So this is one thing. This is safe haven gold. But then there's also what we call performance gold. This is silver plus gold and silver mining equities. They have to be actively timed. Because I can tell you from real life experiencing, managing money in that space, in mining, there's so many things that can go wrong. And most of the times, all those things go actually wrong. So that you've got geological risks, you've got permitting risks, you've got environmental risks. Then you've got price risks coming from the underlying, from gold and silver itself. Then you've got management risk, you've got capital market risk, you've got interest rate risk, and you've got inflation, obviously, for human resources, but also the materials that you need, energy, and so on. So it's a really complex business, But it's like if you're buying a leveraged play on insurance. So it is something that you have to be really active. From my understanding, after almost 20 years in this industry, I think it's not a buy and hold asset class. You really have to be active. It's something where you can be the best fund manager, and if you're in a brutal bear market, you will still be down 70% in the mining space. So we're really actively managing our risk exposure. But I think there's a strong case for mining stocks, but also for silver. On a relative basis, silver is just so cheap, and in absolute terms, we're now at the same levels like in 1980 and in 2011. So I think now performance gold is a great idea. I'm making the analogy with the Tour de France, where Pogačar made this big breakout, on the Ottercam, which is it was really decisive for that race. So we are seeing that now silver and mining stocks are now finally breaking out, and in the second half of every big gold bull market, it's really the time for performance gold to outperform. So gold always goes first, and then with the time lag, it's silver, the mining stocks, and then commodities following. And this is what we're seeing now.
So now in the silver phase, how much more room do we have? A lot of people and also experts, commentators say, well, it's similar to 1980s, but inflationally adjusted, we're actually way below.
Yeah, so I think triple digits easily. The gold-silver ratio is now at 80.
Time frame?
It can happen like in the next 12 months. Just 1 year ago, when I was presenting here at the Precious Metal Summit, the price of gold was 2,700. Now we're above 4,000. The price of silver was 32. Now we're at 50. So the gold-silver ratio is still above 80. The long-term historical median is 60. So we're still way above that median. And we know that in a big bull market, at the peak of a big gold bull market, the gold-silver ratio tends to go to 15 to 20. So, if my ambitious gold targets are accurate, then silver is probably the buy of the century now. So if gold goes to, let's say, 6,000, and we go to a gold-silver ratio of 20, I mean, the math is pretty easy. That's a $300 silver price. It sounds like really, really ambitious now. But I cannot rule it out, actually. And, the thing is, you've got this enormous amount of physical demand from the photovoltaics industry. We're seeing the 5th year of a supply deficit in silver now. What's still missing is investment demand. And I think that at some point people say, gold is already too expensive for me. Let's buy the little brother. Let's buy silver, which is still pretty cheap. So I think once investment demand really kicks in, then I think that's going to be like the perfect storm for silver.
If we look at now mining stocks, there's also different phases in that, I guess, right? Where juniors start picking up on seniors and all that. And how would you then go about that for someone who, let's say, has never really invested in mining stocks? What would be your advice?
Don't buy single mining stocks. If you don't have the time and the expertise, buy a fund, like our fund, for example, buy an ETF, but really diversify your risk, because it's not only a bottom-up asset class, because you have to understand the geology, you have to understand, if it's possible to bring good geology actually to the market and to develop that mine? Yeah, do you have a good management? Yeah, how, are they able to raise money? In which jurisdiction are they? Yeah, what can happen to that jurisdiction? Yeah. So this is very much of a bottom-up game, but then also a top-down game, because you have to understand where we are in the big gold cycle. You can have the best mining company, yeah. If you're in a brutal bear market for gold, it's not really gonna help, yeah. So it's top-down, but also bottom-up, and that makes it so fascinating, but also so complex, and then in the end also so rewarding if you're right in that sector, yeah. But I think if you don't have the time and the expertise, just buy an index fund or a mutual fund.
Do you think we will return to a form of a gold standard?
I think there will be some sort of a gold backing. I don't think that we'll go to a real gold standard. I think it could be more like a kind of a commodity related basket where gold also plays a major role. But I think that, coming back to the topic of trust, and, our report is called In Gold We Trust. And I didn't have any idea when I was a young kid writing the first report that trust is such an important topic. Yeah. And we are seeing this, like Hemingway said, yeah, gradually then suddenly we're seeing this erosion of trust. In science, we're seeing it obviously in politics, we're seeing it in the media, we're seeing it in our society, and we are also seeing it in the gold world. And I think if you want to establish trust in a new currency, whatever that is, I think you need that trust capital that gold provides. That gold has achieved through a trial and error process that went actually on for the last 5,000 years. And it's no coincidence that, on every continent, in every major religion, people throughout history realized, well, actually gold is like the best money. And it's not seashells or cigarettes or tuna cans or paper or whatever. So I think like in the next system, whatever that is, yeah, I think gold will play a major role. But let's not be naive, and we know that politicians hate the straitjacket that a gold standard provides, yeah. So there will be some sort of, I think if it's like a 20% gold backing, for example, and then some commodities and perhaps also Bitcoin and whatever, I think that a little bit like what Keynes proposed back then in Bretton Woods, something like that could be feasible, and I think that could also work with the BRICS countries that are actually dominant commodity producers. That would be my best guess, actually.
And to conclude, I would like to know your position on Bitcoin as well, because you also yourself own Bitcoin. You advise a 5% allocation of Bitcoin in your portfolio. Why is that among all the gold bugs, the gold people, you're one of the few who is so positive about Bitcoin? Well,
just one thing, I really don't like the term gold bugs, because it's like, it's so negative. And most of the people that I know in the gold scene, they are well-read people. They know about history, about monetary history. And, I think, there's no convertible bugs or equity bugs or whatever. And I think that we in the gold industry, we shouldn't call ourselves gold bugs. Yeah, I think we should, perhaps sound money is like the better term. Yeah, for what I really would see myself in, the sound money camp. So I know that Bitcoin is a very controversial topic. Yeah, and that many people in the gold space don't like Bitcoin. From my point of view, I'm a free markets guy. I'm a libertarian. I like competition. I think competition makes everything better. Why shouldn't there be any competition when it comes to money? Hayek wrote about that. And I discovered Bitcoin very early. About my first Bitcoins like in 2012 through libertarian friends, and this is just a huge success story. Back then, if somebody would have told me that like 13 years later, the US would be talking about a strategic Bitcoin reserve, and that like Wall Street is embracing Bitcoin, which you can also argue that it's not only a good thing, but I think that Bitcoin actually has a pretty positive and exciting track record for such a short time frame, and it's not a young kid anymore. It's not the wild teenager anymore. It's really growing up, and it's becoming more institutionalized. And I know we got lots of hate from the gold community, but also from the Bitcoin community, because they don't like gold. They think it's something of the past. We like both, and I always make the comparison. You can have in your garage, you can have like the big solid SUV like the Land Rover or the Volvo or whatever, but you can also have a Ducati motorcycle, with Ducati Panigale with 200 horsepower. You can have both. Actually, Ducati is more fun, but when it's raining, when it's icy, when it's foggy, you probably rather want to sit in the Land Rover. But why not have both? And my take is, obviously gold has a very, very long track record. Bitcoin has a much shorter track record, but the track record of Bitcoin is excellent from a technical point of view, but also from a performance point of view. And I think that whoever Satoshi Nakamoto was, he clearly understood gold. He understood the flaws of our monetary system. He understood the stock-to-flow ratio, which was, for me, in my gold story, probably one of the most important points when it really, this was like a pivotal moment for me when I understood the stock-to-flow ratio. And, Bitcoin now has a higher stock-to-flow ratio as gold, actually. So both are very, very hard currencies where that you cannot be inflated at will. For gold, it's like 1.5% per year. That's a natural inflation of the gold money supply. For Bitcoin now, it's even less. It's like 0.8%. And it's every 4 years it's halving. So I think this certainty from a geological point of view, and then also from a technical point of view in Bitcoin, is something that we just need in this world, where basically central bankers can wake up in the morning and say, okay, let's increase the money supply by whatever. So for me, the combination of gold and Bitcoin totally makes sense, and there are more and more people waking up to that idea, because if you rebalance it, and actually gold and Bitcoin do not have any long-term correlation, which makes it even better to combine the both in one portfolio. And the risk numbers are just staggering. So I feel very, very confident with our solutions, and I think it's also important to bring together those two camps. I remember when e-papers came out, and people were starting to read articles online. People said that's the death of the newspaper. I still enjoy reading a proper book, like a printed book. I enjoy having a newspaper in my hands. I also enjoy also enjoy reading PDFs and so on. But why not have both? And I think this kind of, it is like in this Life of Brian, Monty Python. I think, this is ridiculous arguments having. We should be one sound money camp and make the case against fiat money, against, this debt situation and so on. So this is kind of the mission that we're in. And I hope that we make a little contribution to that.
I totally agree with you. I think there's too much of hate on both camps towards each other. fighting each other instead of fighting the debasement that we experience, which is mainly fiat currencies. And one thing I was asking myself is that indeed, Bitcoin is the hardest money. And eventually by 2100, the last Bitcoin will ever be mined, and it will only be 21 million Bitcoin, making it super hard and thereby very deflationary. I mean, if you own Bitcoin, obviously. And that also is one thing that I always ask myself is what the effect would be on the economy, because something that has total capped supply would also have an influence about the way an economy is run. And a natural inflation of 1 to 1.5, maybe to 2% max might be something that you can work on because it's something that gradually, predictably increases. So what is your view from an economical perspective, like how that would actually work together?
Well, before 1913, we actually had like, I think 47% of all the years we actually had deflation. So the swings between deflation and inflation were pretty wild. And then we've got a brilliant chart on that. I forgot the numbers, but then I think between 1913 and 1971, there was way fewer years where we had like any deflation. Since 1971, it's basically, it's non-existent because everybody says deflation is bad. Of course, deflation is bad. If you're heavily over indebted, then deflation is your worst enemy. So obviously, and we've seen it in history, deflation doesn't necessarily have to be bad for an economy. And I think that, Jeff Booth wrote a brilliant book about that. And, technology and our entrepreneurial spirit makes everything more efficient and cheaper. It's just that within our monetary system, we need inflation because it's a debt-based monetary system. And you simply cannot accept any deflation in this system. But previously, deflation wasn't like a big problem. Yeah. So I would say like in the year 2100, will I still be alive? Well, it depends on, the invention. I will be above 120 then, let's see. But I would love to have a conversation then. But I think that if you study monetary history, then you will see that deflation is actually something pretty normal in a, let's say, in a different or in a more healthy monetary system than the one that we currently are.
Ronnie, thanks a lot for your time.
Thank you.
And for the contribution you make to the industry as well through the report and all your team. And is there anything you want to finish on? Obviously, well, to the viewers and listeners, your reports are always available. They're free. Yes. You can download them straight from the website. But is there anything you want to share or conclude with?
No. Have a look at our webpage, ingoldwetrust.report. You can download all our publications, also the previous publications for free. You don't have to register. We publish in German, English, in Mandarin, in Spanish, and starting this year also in Japanese. Have a look at our webpage, incrementum.li. This is like our investment solutions. I'm pretty active on Twitter. My handle is at Ron Stoeferle. And then I think the message is, somebody said, save like a pessimist, but invest like an optimist. And I think that's a good one. And I think despite all the things that we're experiencing now, there's still many reasons to be optimistic. I've got small kids, and so I necessarily have to be optimistic. But then on the other hand, my grandparents are unfortunately not alive anymore. But I think, they lived through the world wars, through, currency reforms and really hard times. And I think people are really, there's a bull market in, people complaining about everything. Yeah. But actually, if you compare it to the times that they lived through, we're living in the best of worlds. So, enjoy the good things. Yeah. Think positive and study history, study monetary history. And then I think everything's going to be all right.
Beautiful conclusion.
Thank you very much. Appreciate it.